Life is growth. Business is growth. You grow or you die. He says it without emphasis, not as a philosophy, but as a correction to a banker who believes restraint protects a business. The banker sees expansion as risk because inventory and receivables scale faster than cash. He assumes slowing down keeps the company safe, understands that slowing down would cut the company off from its only source of financing. In a business built on external credit, growth is the collateral. Without it, the bank has no justification to lend. If the company grows, the bank must continue. If the company stops, it loses both credit and oxygen. This is not strategy, this is structure. He forms Blue Ribbon without capital, which means every decision must convert borrowed money into product and product into proof of demand. Proof, not funding, forces the bank to extend credit. The entire operation depends on inventory velocity, not profit, not planning, movement. He doesn't raise investment before starting. He starts, then uses the start to force financing. He negotiates Japanese distribution rights before having any infrastructure. He orders shoes before having the money to pay for them. He uses customer demand to leverage credit, and he uses credit to fulfill demand. This inversion is the foundation of Nike. The customers become the capital providers because their orders justify borrowing. The supplier becomes the first bank by extending terms, and the banks become suppliers of oxygen, not partners. When profit appears, it is never removed from the system. The company does not treat earnings as income, but as leverage to expand inventory cycles. Profits are reinvested immediately, converting margins into physical product and eliminating available cash. This forces short-term loans to close timing gaps between shipping from Japan and consumer payment. The faster the reinvestment, the more stressed the company's liquidity becomes. That stress is not a mistake. It makes the business look unstable on paper, which justifies higher loan levels to meet demand. The bank funds instability because the instability is associated with sales, not losses. He creates a system where financial health is impossible to measure without growth. Stopping to accumulate reserves would collapse the cycle. He has no choice but to expand. The bankers don't understand. They ask him to slow orders, build cash reserves, reduce liabilities. They recommend the standard safety measures of small business finance. But Blue Ribbon is not a stable business model. It is a leveraged distribution engine. It does not own the product. It does not own manufacturing. It does not own resources. Its only asset is speed. If speed drops, the business loses credibility, the bank reduces credit, the supplier tightens terms, and the company dies. Risk comes from slowing down, not accelerating. At this stage, growth is not ambition, it is survival logic. Factories in Japan do not treat him as a partner. He is a small account forcing orders that exceed his financial depth. They're not threatened by him. They are not impressed by him. They see him as a channel, not a future competitor. But every order he places ties him more tightly to the bank, and every shipment increases the size of his receivables. This makes the bank dependent on his expansion. The bank cannot withdraw without writing off existing exposure. Growth locks the bank in. As long as orders increase, the bank must continue lending to protect its past loans. His only form of protection is acceleration. This is why he adds new territories long before he can afford them. New states produce new orders. New orders justify new loans. New loans accelerate the company beyond its financial capability. This is not recklessness. It is a planned imbalance. He controls only one variable: demand. As long as sales outrun supply constraints, the financial constraint becomes the bank's problem. They must extend the line, or they must write off a business that is growing. Growth becomes an ultimatum. The business grows not because it wants more revenue, but because it needs pressure to force continued credit. He hires aggressively, but without salaries to match the workload. Compensation is structured around minimal base pay and the implicit promise of future upside. This is not a culture choice. It is a liquidity necessity. Employees willing to work under these conditions are not motivated by stability. They are motivated by urgency. A person who demands structure, process, or predictability cannot exist here. Their need for security would slow the system down and introduce fatal prudence. He selects personnel who tolerate volatility because the business has no room for caution. They must accept chaos because the company itself is built on imbalance. Product feedback is prioritized, not as branding or innovation, but as a form of supply chain optimization. Product flaws slow demand. Slow demand reduces orders. Reduced orders eliminate the justification for financing. So product improvement becomes a financing requirement. Athlete partnerships are not for marketing exposure, they are design accelerators. Feedback shortens product cycles. Shorter product cycles justify larger purchase orders. Larger orders justify larger loans. Athletes do not expand brand equity yet, they accelerate the balance sheet. Bowerman's experimentation is valuable not because it creates better shoes, but because it compresses time. A new design eliminates aging stock, avoids discounting, increases pre-orders, and forces factories to speed up production. His tinkering is not creative freedom, it is financial strategy. Every improvement forces demand velocity. Every improvement reduces risk, not by stabilizing the company, but by destabilizing the product cycle in the company's favor. The company becomes stronger and weaker at the same time. Stronger because orders grow. Weaker because larger orders create larger obligations with no cash cushion. The bank sees only liability growth. He sees only leverage growth. This tension is the price of scaling without capital. He is not building a brand. He is building a financing machine that sells shoes. If he stops moving, the machine stops working. Growth increases credit demands, and increased credit increases scrutiny. Banks begin requesting traditional assurances, audited statements, projections, slower expansion. None of these requests can be honored without breaking the financing model. A projected slowdown would immediately undermine credit justification. Auditing reveals liquidity deficits that look irresponsible on paper but are required in practice. Accounting transparency without context becomes a liability. Blue Ribbon's numbers look unstable not because it is collapsing, but because it has converted stability into leverage. Any accountant trained in corporate conservatism interprets risk where Knight sees necessity. He understands that transparency must be selective. It is not dishonesty. It is survival through contextual omission. He gives banks accurate sales velocity, advanced purchase orders, confirmed receivables. He withholds structural instability because they cannot interpret it correctly. Risk to them is loss. Risk to him is stagnation. If they see the business fully, they will attempt to slow it down, and that slowing will kill the business. This conflict is not personal, it is structural. Banks preserve value, Knight produces velocity. Both cannot operate with full knowledge of each
raising
other.
equity from outside investors in the early years, because equity reduces leverage and increases oversight. Investors would demand governance, budgeting, strategic restraint, and risk metrics. These measures undermine the leverage structure. Investors do not accept instability as a financing mechanism because they are not lenders. The company must remain privately unstable to become publicly viable later. The absence of capital creates the future IPO. Private capital would have eliminated the company before it learned to outrun its own debt. Onitsuka becomes a threat only when it realizes that Blue Ribbon generates sustainable volume. At first, Blue Ribbon is a useful novelty in their portfolio. It provides American distribution without significant investment risk. But as volume rises, Onitsuka recognizes that Blue Ribbon is not a reseller, it is building demand. Once they identify the dependency, they attempt to control it. They begin searching for alternative distributors to replace Knight. They do not want to share the upside. They want to capture all of it. Knight responds not by strengthening the partnership, but by preparing to destroy it. He documents conversations, orders, promises, and contractual terms. He predicts legal conflict and builds archives as a strategic asset. Entrepreneurship here is not creativity. It is documentation. When the Japanese executives attempt to terminate the relationship, Knight attacks not emotionally, but procedurally. He uses contracts as leverage. He uses history as evidence. He uses paper the way most startups use capital. Lawsuits replace investment rounds. The company cannot afford lawyers at scale, but it cannot afford submission. Litigation becomes bridge financing for autonomy. When they win, Blue Ribbon becomes Nike out of necessity. They cannot risk dependency again. Manufacturing autonomy is not innovation-driven, it is credit-driven. If they control production, they control delivery cycles. If they control delivery cycles, they control receivables timing. If they control receivables, they control loan justification. Ownership of manufacturing is not creative empowerment, it is credit stabilization. Factories now respond directly to Knight's urgency. Delay is no longer interpreted as supplier inefficiency. Delay becomes internal failure. He eliminates excuses by eliminating third-party control. Vertical integration is not about margin improvement, it is about time compression. Time is the business. During Nike's early production, the swoosh logo is purchased for $35 not because it is valued cheaply, but because it is not yet instrumental to financing. Branding has no credit function at this stage. Banks do not lend against future brand potential, they lend against contracts, receivables, and sales orders. He invests minimally in aesthetics because aesthetics do not shorten the cash cycle. The logo becomes valuable only after Nike escapes dependency. Iconography becomes an asset only once the debt engine is stabilized. Athlete partnerships expand, but they are negotiated as performance collaborations, not image licensing. Prefontaine pushes design changes rapidly. This reduces time between product versions, increasing obsolescence of existing stock and forcing continuous demand replacement. The athlete is not a spokesperson, he is an accelerant. Nike's innovation cycles align with financing cycles. A new shoe is not just a product, it is a reset on inventory valuation. Outdated stock loses borrowing justification. Newly designed stock increases it. The athlete-driven redesign is a credit weapon. Nike is not built for comfort, it is built for movement. It does not accumulate wealth, it deploys it. It does not defend its market position, it races it forward. It does not negotiate for safety, it negotiates for acceleration. The entire supply chain aligns around urgency because urgency is the only condition under which the business can exist. Japan supplies product, the US distributes and sells it. Banks fund the gap in between. This three-party system keeps Nike alive, but it also exposes a structural weakness. Nike has no internal liquidity buffer. Every dollar cycles to product, debt, or receivables. Nothing sits idle. Nothing protects against disruption. A delayed shipment becomes a financial crisis. A lost invoice becomes a liquidity event. A miscounted delivery becomes a threat to survival. The company functions without redundancies because redundancies require capital, and capital would slow velocity. The banking relationship reaches maximum strain when Nike's volume outgrows what the bank can justify internally. On paper, Nike appears irresponsible. It has no cash cushion. It has rising liabilities. It has unpredictable product needs. It violates every lender instinct. The bank tries to impose conditions unrelated to growth. They want restrictions, approvals, controlled pacing. They believe safety is created through moderation. For Nike, moderation would remove the only proof that financing should continue. The bank cannot understand a business where safety equals acceleration. Eventually, the bank withdraws full support. They tighten the line and attempt to force Nike into slower operations. Knight interprets this not as caution, but as a threat. Without credit flow, orders will fail, receivables will stall, cash cycle will break, the company will collapse. There is no internal reserve to absorb the interruption. Nike must find alternative financing immediately, or the bank's protective caution will kill the company. Caution is risk. Restraint is failure. If he stops moving, the business stops breathing. He turns to Japanese trading companies for credit. These firms finance international commerce by advancing capital against orders and shipments. They operate like banks, but assess risk through volume, capacity, and distribution, not conservative metrics. They value aggressive demand. They expect volatility. Their business model benefits from corporate speed. Where banks slow companies, Japanese trading houses accelerate them. They provide exactly what Nike needs: large credit supply tied to product movement, not to balance sheet optics. This shift changes everything. Financing is no longer constrained by bank fear. It aligns with Nike's nature. Credit expands. Orders expand. Factories scale. Nike converts instability into expansion. Traditional banks cannot compete because their underwriting logic penalizes velocity. Trading houses finance velocity. Nike outgrows domestic financing because domestic financing is structurally incompatible with its
Nike
business.
can escalate production and reduce dependency risk. He does not prioritize margin, he prioritizes control. Manufacturing contracts are structured for delivery speed and volume flexibility, not price efficiency. He sacrifices short-term profitability to maximize supply responsiveness. Profits are still reinvested. Liquidity is still avoided. The goal remains the same: maintain the cycle. Slow maintenance kills the business faster than aggressive expansion. Endorsements shift during this phase. The company no longer needs athletes to justify product development. It needs athletes to justify category creation. Each new sport represents a financing layer. Each category multiplies product lines. Each product line multiplies orders. Each order multiplies receivables. Receivables justify more credit. Athlete endorsements now support diversification, not identity. They do not sell shoes, they produce categories. The business model evolves from leveraged distribution to leveraged manufacturing and market segmentation. Nike does not become stronger by becoming stable. It becomes stronger by diversifying the instability. No category can slow down. No product can stagnate. Each division must race at its own speed. Nike becomes a portfolio of acceleration, monitored through order flow, not controlled through protection. This diversification amplifies liquidity stress. The company is growing across sports faster than existing financing systems were designed to sustain. This speed forces a transition to public markets. The IPO is not a milestone of success, it is refinancing. Private debt has reached its structural limit. Public equity transfers risk and enables scale without violating the acceleration model. Investors tolerate instability as long as growth remains measurable. The public market rewards velocity. The bank punished it. The IPO replaces incompatible lenders with scalable tolerance. After the IPO, Nike has capital, but capital does not change its operating philosophy. The new funds are not retained as cushion, they are deployed. The company does not use public status to pursue stability. It uses liquidity to scale the same unstable system at higher capacity. Investors expect growth, the same way banks pressured restraint. Nike treats expectations as leverage. Visibility becomes a financing instrument. Public markets replace banks as the entity forced to support acceleration. Nike does not design the company to optimize shareholder returns in the conventional sense. He designs it to maintain velocity. Where banks demanded caution, markets demand performance, and performance is measured through expansion, not preservation. Nike directs public capital into manufacturing capability and category growth, not into savings or dividends. Dividends would remove resources from the acceleration cycle. Nike avoids them. The company remains a reinvestment machine. Supply chain management grows more complex after the IPO. Nike must diversify its factories across regions to mitigate dependency risk. But diversification is not a risk hedge, it is a time hedge. Regional capacity reduces bottleneck risk and compresses lead times. Shorter lead times reduce cash cycle exposure. Manufacturing stability reduces financing instability. Nike uses scale to engineer time. Scaling product lines introduces operational contradictions. More categories increase manufacturing risk. More SKUs increase forecasting error. But volume reduces cost per unit and accelerates receivable flow. Risk and efficiency rise simultaneously. Nike accepts forecasting inaccuracies because velocity reduces the cost impact. Under this logic, mistakes are cheaper than stagnation. Slow accuracy is more dangerous than fast error correction. Research and development becomes a structured expense, not a discretionary one. Innovation compresses the obsolescence cycle. Rapid obsolescence forces repeat purchases. Frequent product renewal justifies large advance orders. Advanced orders justify manufacturing runs. Manufacturing runs justify financing. Innovation is not branding. Innovation is loan justification. Marketing evolves only after manufacturing and financing align. Nike marketing in its mature phase does not sell features, it sells movement. Movement supports financing logic by accelerating consumer demand and reducing product age. Advertising becomes a velocity multiplier. Campaigns are not designed to change perception indefinitely, they are designed to accelerate turnover immediately. This leads to aggressive athlete deals as markets expand. High-profile athletes are no longer iteration tools, they are distribution accelerators. A major athlete can collapse a multi-year adoption curve into a single quarter. That compression enables Nike to introduce product into a new market segment at velocity, reducing the risk of category stagnation. Athlete endorsement costs are evaluated not against branding value, but against time reduction per category rollout. Cost-benefit analysis shifts from margin enhancement to acceleration return. Nike does not tolerate slow product cycles. Slowness is risk, not caution. Slowness increases inventory age and weakens loan justification. There is no safety in predictability. Predictability encourages banking logic. Nike rejects banking logic. The company redefines operational success as compression of time between design, adoption, and replacement. Every department exists to shorten cycles. The company enters global expansion using this same logic. New markets do not develop organically. They are forced by distribution surges, athlete representation, and compressed product cycles. Nike does not localize slowly. It overwhelms markets with volume, awareness, and turnover. Local suppliers cannot compete with a company that treats speed as cost reduction. Nike forces incumbents into slow failure. Competitors cannot match acceleration without destabilizing their legacy structures. Nike's instability becomes advantage. Competitors operate using margin-first logic. Nike operates using velocity-first logic. Competitors defend brand position. Nike replaces it repeatedly. Competitors treat popularity as scarcity. Nike treats popularity as signal for reinvestment. Competitors protect categories. Nike overproduces categories. Traditional sports companies sell identity. Nike sells iteration. Nike's internal culture reflects the financing system. It rewards problem-solving under pressure, not planning. Employees are selected for tolerance of uncertainty, willingness to improvise, and focus on execution over deliberation. Corporate hierarchy remains loose because hierarchy slows decision cycles. Decentralization accelerates decision flow and allows each product category to act as an independent acceleration node. Managers do not control growth, they chase it. Strategy is less designed than reacted to. Reaction speed is an asset. Long-term planning is tolerated only if it serves immediate execution. Nike does not attempt to create a motivational culture. He does not articulate vision in inspirational terms. He prioritizes autonomy, expecting employees to function like entrepreneurs inside the company. They are accountable to outcomes, not processes. Individuals who require linear structure are replaced. Work is intense. But intensity is not mandated from above. It is necessitated by the financing architecture. Employees internalize urgency because slowness creates visible, immediate business failure. There is no need for slogans or speeches. Pressure is the culture. Many employees become loyal not because of emotional connection, but because they are given authority early, trusted to operate beyond their formal experience, and measured purely on performance. Nike does not hire for credentials. It hires for velocity compatibility. It is less a corporation and more an ecosystem of decentralized problem solvers tied together by shared financial dependency. Growth is the unifying language. People who excel in this environment often cannot function within traditional corporate structures that reward
Leadership
preservation
is defined by
over acceleration.
disappointment tolerance. He allows failure as long as it is fast. Mistakes that are resolved quickly are acceptable. Hesitation is not. He manages not by preventing risk, but by ensuring rapid iteration after risk. He removes people who slow the system. He promotes people who absorb pressure and operate independently. Leadership at Nike is not about direction. It is about friction management, ensuring that operational speed remains unimpeded by individuals who need certainty. Cash shortages continue even after Nike becomes a household name. The company is often illiquid despite rising revenue. Success increases operational strain. Inventory scale requires larger credit facilities. Inventory speed must increase with company size. Order volume forces manufacturing expansion. Every milestone creates new exposure. Nike never outgrows financial vulnerability. It transforms vulnerability into a requirement for more growth. The company cannot mature into stability. Stability would reduce its financing logic. This creates an unusual business maturity path. Nike grows, but it never becomes comfortable. It remains structurally pressured, intentionally. Nike believes a business built on comfort loses capacity for urgency and then dies. The company's equilibrium is imbalance. Its strength is tension. Its continuity is instability. Long-term sustainability depends on institutionalizing acceleration so deeply that it outlives leadership. This is where the company's final strategic identity forms. Nike becomes the institutionalized pressure of consumer performance. It does not merely serve athletes, it mirrors them. Athletes are driven by constant improvement, discomfort, and competition against personal limits. Nike adopts the same psychological environment at the corporate level. It does not emulate sports through advertising. It mimics sports through business operations. It commercializes athletic mentality by living it internally. Nike does not sell products. It sells velocity embodied in products. It sells the expectation of iteration. It sells consumer replacement cycles. It sells identity through acceleration. The consumer is trained to expect progress. Progress demands new items. Function demands improvement. Improvement demands urgency. Nike uses consumer psychology as a supply chain lubricant. If customers slow their replacement cycle, Nike's financing suffers. Therefore, Nike teaches customers to expect continuous improvement. Marketing becomes education in acceleration. This turns Nike into a brand of movement rather than meaning. Other companies sell purpose or tradition. Nike sells momentum. The swoosh becomes recognition of movement, not ideology. The checkmark shape resembles nothing athletic specifically. It implies acceleration. Its value grows as the company trains millions of customers to interpret it as a signifier of change, not consistency. Consumers buy change. Change funds production. Production funds credit. Credit funds growth. A brand becomes a financing loop. Nike did not find its identity and then grow. It grew and then found the identity forced by its financing model. Growth created meaning. Survival created philosophy. Acceleration created culture. Branding simply documented what financing had already required the organization to become. Nike ends up proving something that contradicts how most businesses are taught to operate. Stability is not a prerequisite for scale. Stability is the enemy of scale. The company does not accumulate strength before growing. It grows to survive, and that survival becomes strength. Profit never created Nike. Profit was recycled. Capital never protected Nike. Debt funded speed. Planning did not predict Nike. Iteration under pressure produced it. The principles that build safe companies do not build global ones. Safe companies slow down. Slowing down reduces demand. Reduced demand reduces financing capacity. Reduced financing collapses the company. Safety becomes failure, disguised as caution. Businesses that hoard cash operate on fear. Businesses that deploy cash operate on urgency. Nike turned profit into inventory, inventory into receivables, receivables into leverage, and leverage into control. Most companies try to earn control before using it. Nike used growth to acquire control. Control came last, not first. The company spent decades unable to choose comfort. Comfort would have destroyed its financing logic. Comfort would have invited death. When Knight says, life is growth, business is growth, you grow or you die, he wasn't giving advice. He was reporting a fact. Nike survived by growing, and it will die the moment it stops.